So we are going to look at what we call disposable group. Then we look at change of plan, where there will be like the reason for classifying the asset ahead for. So we don't want to sell again. So if you don't want to sell again, what are you going to do? Okay, we are going to look at that also. Then we look at what we call discontinued operation. Okay. All right. Disposable group. You see, under 36, IS 36, we look at impairment, where we look at what we call a cash generating unit. A cash generating unit, we basically say that a group of assets generating what? Cash flow dependently. It means that the each of the items in the cash generating unit cannot generate or produce an independent cash flow. It has to depend on the other item in the unit to determine the cash flow. So a group of assets generating cash flows together, that's what we call the cash generating unit. All right. If you want to sell a cash generating unit, we name it what? A disposable group. So if you have an asset that they are not, none of them can generate cash flows independently, they have to depend on each of the items in the what? In the cycle to determine the or to generate the cash flow. We say that is a cash generating unit. So a group of assets generating cash flow together, that is a cash generating unit. But if you decide to sell or to dispose of the cash generating unit, we classify it as disposable group, not non-current asset held for sale. The non-current asset held for sale is for just for a single asset, an asset that can generate a cash flow on its own, a single asset, like plants. If you want to sell the plant, then the plant will be classified as held for sale. But if you want to sell a group of what? A group of plants, then you can say that is a disposable group. So a cash generating unit, if you want to sell it, it is named as what? A disposable group, not held for sale. All right. What do we call a disposable group? We are saying that a group of assets that can be sold in a single transaction. A group of assets that can be sold in a single transaction is what we call a disposable group. So if you have a provision store, you can't sell the store without the what? Without the space. You can't sell the store without a bulb inside the store. You can't sell the store and say that you are going to take what? The tables and some of the things out of the store. No. If you are selling the store, it means that you are selling everything in the store. So you'll be selling the bulb, you'll be selling the tables and everything. So all those things that you are selling is what we call a disposable group. You can see that you are selling the bulb, the tables and everything in a single transaction, which is the what? The store that you are selling. So a group of assets that can be sold in a single transaction, that is what we call the disposable group. How does it work? It works like what? The cash generating unit under what? Under the impairment of assets. So what do we do? We determine the carrying value of the disposable group. We determine the carrying value of the disposable group at the date of what? The decision to classify them as held for sale. Okay. One thing that you have to know is that assets that are carried under revaluation model must first be what? Revalued before the classification. So assets that are carried under the revaluation model must first be what? Revalued before the classification. All right. What you also have to know is that the cost to sell is determined for the entire disposable group. You are not selling single item in the group. So the question can give you the cost to sell for each of the items. No, unless the question says that you should put all the summation of the cost to sell for the individual asset is a best estimate or is a best representation of the cost for the disposable group. That is the only way that you can add them. If you are looking for the cost to sell, we find the cost to sell for the disposable group as a whole, not individual items, because you are not going to be selling the asset or the items one by one. No, you are going to sell the disposable group in a single transaction. So you're not going to say, okay, let me sell the tables first. Let me sell the box first. No, you are going to sell all of them in a single transaction. So we determine the disposable or the cost to sell for the group as a whole. You have to take note of that. You also have to take note that at the date of the classification, assets that are carried under the revaluation model must be revalued before the classification. And at the date of the classification, you have to determine the carrying value of all the assets. There might be inventory in the group that you are going to be using the principles of what? The IS2 inventories to know the value that you are going to be putting for the inventory. There will be receivables there. You will also be using the principles of the financial instruments or maybe provision for bad debt and those ones. So you have to account for the individual items in the group using their respective what? Standards. Using their respective standards. Okay, the question now is if we determine the carrying value of the group as a whole, and this is 1,200, and the net realizable value of the group is 1,000. What is happening? The carrying value of the group is 1,200, and the net realizable value is 1,000. What is happening? There is an impairment of what? There is an impairment of what? 200, isn't it? Okay.
Yeah.
This impairment will be shared like the way we share impairment under impairment of asset for cash generating unit. The first one will be physically damaged assets. So you ask yourself, is there any physically damaged asset? If there is any physically damaged asset, it means that that asset is worthless. So its value have to be what? Scrapped off. It have to be written off. So the first will be physically damaged assets. If there's a physically damaged asset and you have apportioned the what? The impairment to it and it is left with some of the impairment again, the next in line should be a goodwill. Should be goodwill. Okay, should be goodwill. If after the goodwill we still have some impairments left, then it should be shared to other assets that are likely to be impaired in the proportion of their what? Their carrying value. So you pro rata the rest. So that you prorate the remaining what impairments to the assets that are likely to be impaired in the proportion of their what their carrying value. In the proportion of their carrying value. Sometimes you can also have the intangible or indefinite intangible assets in the group. These assets have to be what? Have to be tested for impairment annually. So you can, if there is an intangible, if there is an indefinite intangible or intangible asset with indefinite useful life, they have to take the impairment before the you do the pro rating. You do the pro rating. So what we have to know about the disposable group is that disposable group are those assets or is a cash generating unit that will be disposed of in a single transaction. So you sell the store as a whole in a single transaction. You are not going to sell the table today, the this thing tomorrow. No, you sell all of them in a single transaction. That's what we call the disposable group. So you deciding to sell a cash generating unit is what we call the disposable group. If you are going to do the classification, you have to do the you have to determine the carrying value of the asset one by one. Assets that are carried under a revaluation model must first be revalued before the classification. Assets that are carried under the cost model must be depreciated up to the date of what? The classification. So you have to do all those things. And you have to know that the cost to sell is determined for the group as a whole, not individual what items. So they can give you cost to sell for individual items, ignore them. We determine the cost to sell for the group as a whole, as a whole. All right. Let's do this. Let's do this. Let's solve a question on that. Let's solve one question on that. Then we move on. Okay, let's look at question 3. Question 3. Yeah, who is reading for us? Andika. Yeah. Auntie Bernice, can you read for us? Auntie Bernice, are you there?
I'm there.
Okay. Please read for us.
Beacon Limited acquire all the equity shares in Jamila Limited on 1st June 2018 for a consideration of 1,250,000 Ghana cedis. The carrying amount and the fair value of the identifiable net assets at acquisition were 1,230,000 Ghana cedis. On 31st December 2020, Beacon Limited was in the process of selling its entire shareholding in Jamila Limited, and so it was decided that Jamila Limited should be treated as a disposal group held for sale in accordance with IFRS 5, non-current asset held for sale and discontinued operations at that date. The carrying amount of Jamila Limited net assets before classification as held for sale as 31st December 2020 in the individual statements of financial position were as follows. Okay. Should I read that one?
You just read the additional information. The group has a policy of
Okay. The group has a policy of revaluing its property, plant and equipment in accordance with IAS 16, property, plant and equipment. There have been no revaluation or any other gains or loss included within Jamila Limited's different components of equity since the date of acquisition, as the carrying amount was deemed to be a close enough approximation to its fair value. However, on 31st December 2020, property with a carrying amount of 330 million Ghana cedis was considered to have a fair value of 340 million Ghana cedis. No adjustment has been made for this fair value. The total fair value less cost to sell of the disposal group at 31st December was estimated to be 120 million Ghana cedis. There have been no previous impairments to the goodwill of Jamila Limited. Required. Recommend to the Director of Beacon Limited how the above transactions should be accounted for in the consolidated financial statement as at 31st December 2020, including financial statement extracts in accordance with relevant international financial reporting standards.
okay, thank you. Let's say you should recommend. Don't go there and be saying that the IFRS 5 says that if you want to classify an asset as held for sale, the carrying value have to be recognized through a sale. So the asset to be available for immediate sale. No, they are saying all those things. They have said all those things here. You should assume that all those things are there. Okay, you just tackle the question as the way it is. Okay, they are saying that the Beku Limited acquired all the equity shares in Jamila Limited on 1st January 2018 for a consideration of what? 1,250 million. The carrying amount and the fair value of the identifiable net asset at acquisition were what? Were 1,230 million. So they have acquired all the equity shares. That means they have acquired all the 100% shares. Okay. But the value of the asset that they are buying, what is the value of the asset that they are acquiring? What is the value of the net asset? The value of the net asset is what? 1,230. But they paid how much for it?
1,250.
So what is happening there?
Revaluation
No, please.
of 20.
That cannot be revaluation, madam.
Okay. Gain of 20
That is not a gain.
million.
That is not a
Wow.
gain. The company, Beku, is the one paying to Jamila. So they are paying 20 in excess of what? The amount that they should pay. So that 20 is technically called it's not that they are intentionally paying the what? The 20 million in excess. They are paying the 20 million for something that you and I we can't see. Something that the Jamila
Yeah,
is
that's the
doing.
goodwill.
That is a
Yeah,
goodwill.
goodwill. Yeah.
Okay. They are paying for something that Jamila doesn't value, or they are paying for the skills of the employees that Jamila is having, or they are paying for the strategic location that Jamila is having, which the IS 38 prohibits the recognition of what? Internally generated what? Goodwill. The skills that the employees are having, we can't differentiate the amount that we are paying for the skills and the normal work that they are doing for us. The location, we can't differentiate the amount that we are paying for the rent, which is the land and the location. So these things are internally generated what? Goodwill. But since you are coming to buy it, it means that you have to pay for it. So they are paying the 20 million for that particular one. So what will happen is that Beku has to what? Calculate a goodwill from the acquisition. How do you calculate the goodwill? It is the purchase consideration less the what? The fair value of the asset that you are buying. So that will be calculated as, so they have to calculate a goodwill on the acquisition of, so that will be question 3. So they need to calculate a goodwill on the acquisition. So that will be the purchase consideration, the purchase consideration, the purchase consideration of 1250, then the net assets. So since they are buying all, there will not be any NCI. They are buying all the shares of the company, 100% shares. So there won't be any non-controlling interest. They are controlling all the interest. So that will give us 20. This 20 will give us goodwill. Okay. So they are now giving us what? The carrying value of the assets at the date of what? The classification. The classification was done. They want to do the classification, or the decision was made on 31 December 2020. But you can see that the intangibles over here is excluding the what? The goodwill. Is excluding the what? The goodwill. So we have to determine the new carrying value of the unit now. Let's determine the new carrying value of the unit. So December 2020, we have to determine the carrying value of the assets. So we are going to be having PP. Okay, they have said something about the PPE there. So let's tackle that one. See, they say that there was no revaluation and those things, blah, 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 about the PPE. However, the property with a carrying amount of what? 330 was considered to have a fair value of what? 340. What is happening there? What is happening there? There's a revaluation surplus of what? There's a revaluation surplus of what? How much?
10. 10.
Yeah.
10
Okay.
million.
So what will now be the new value of the property, plant, and equipment?
340.
Yeah, but the 330 is already included over here.
Yeah.
So
So add 10.
we add 10.
846.
Okay, so that will be 836 plus the what? The gain. Are we okay? That will be 846. All right. The next item is what? It's intangibles. Okay, the intangibles is excluding goodwill. So we have intangibles is excluding goodwill. That is 428. Is it 428? Okay, 428. So 428. Then you bring the goodwill itself. You bring the goodwill. The goodwill will be 20. Okay. Then you bring the current assets. You bring the current assets. What is the value of the current assets? 584. 584. Then we have current liabilities. What is the value of the current liabilities?
322.
322. Okay. Okay, non-current is 322. Current is 254.
254.
Okay. So I've taken it. So non-current liability is 2322. So what will now be the new the new current value? What will now be the new current value? You can determine that straightforward without doing anything. You can see that we have only added 30 to this, 10 to this one, and we add 20, which is the goodwill. So just add 30 to this value and get the answer. That will be 1302. Am I correct?
1002.
Okay.
Yeah.
Yes.
1302. Okay. 1302. So what is the next valuable value given to us? Is 1220. So the net valuable value is 1220. So there will be an impairment of how much? There will be an impairment of 1302, 12220.
82.
It will be
82.
82. Okay. So this 82 has impairment. How are we going to share it? Is there any physically damaged asset in the group? Is there any physically damaged asset in the group? Did the question say anything about physically damaged asset in the group? No.
No.
So goodwill will take. Okay. So if goodwill is taken, what will be the balance on the impairment account? It is 82. Goodwill is taking 20. What will be the balance?
62.
Okay, 62.
62.
That 62 will be shared among which asset? Which asset do you think we can share the 62? Okay. Which of the assets over here are likely to be impaired apart from goodwill?
PPU.
PP and which one? And intangibles, isn't it?
Other intangibles.
Okay. You see, you can see that the current asset, they have given you what? The recoverable amount. It means that the recoverable amount is 584. It's the same as the net valuable value. So there is no what? There is no impairment. But they can also give you maybe a different value for the current asset. That means that the current asset has also impaired. So if you are sharing the impairment, current asset has to take its portion. But since they have given you the current asset at recoverable amount, the assumption is that the current asset, the value will be recognized at the same amount. So there is no impairment on the current asset. So let's share the impairment now. PP will be taken, it will be shared in the proportion of their what? Their carrying value. So PP is 846 divided by 846 plus 428. Okay, it will be shared in the proportion of their what? Their carrying value. So multiply by 62. What are we getting? What are we getting? I'm getting 41. Is that correct? Intangibles will be 428 divided by 1274 times 62. That will give us 21. Is that correct? Please, is the 41, 21 correct? Are they correct? 41, 21. Confirm. Then we move on. Okay. Okay. So that's nice. So let's move on. Okay, you see the 41 over here. You see 41 over here. You can decide to find the 340 because the 340 asset, you can see that we have done revaluation on it. So the revaluation currently is 10 in the other comprehensive income account. So if it has impaired, then it means that the impairment must be shared against the what? The the revaluation that was what? The revaluation surplus that was recognized. So you can decide to share the 41 too, and that will be shared as 340 divided by 846 times 41. So you want to know the portion that will be for that particular asset that was revalued. Okay, so 340 divided by 846 times 41. That will be 16.5. So this 16.5, 10 will go to other comprehensive income, and 6.5 will go to what? Profit or loss. Okay. But if you also leave it and take all the 41 to profit or loss, that is nothing, because you are not to make any assumption there. All right. So let's count to profit or loss. What is going to happen in the profit or loss accounts? So the profit or loss accounts, there will be an impairment. There will be an impairment of 82 in that account. And in the other comprehensive income account, there will be a revaluation surplus. There will be a revaluation surplus of 10. So I've said that you can decide to share it. Then you bring the portion of the revaluation surplus here and bring the remaining one to profit or loss. There is no problem with that. Let's count to statement of financial position. Statement of financial position. The statement of financial position, we are going to be having current assets. As soon as we made a decision to sell the assets, the sale is expected to happen within a year. So it means that the asset will now be converted to cash within a year. So it will now be classified as current assets. So the disposable group or the head for sale, which will be the current assets. Okay, let me just put them as current assets together. So the current assets will now be, the total will now be the current asset that we have, which is 584 plus the value now, which will be 846 for the PPE plus 428 for the intangibles, then will now be minus what? 62, which is the what? Which is the impairment. You see the impairment was 82, but 20 was already given to goodwill. So the goodwill has been already written off. Goodwill is not part here. Then you subtract the 62 there. The liabilities will be classified separately. So you classify the liabilities separately and put it there. That's all. Okay. What you have to know is that with this particular group that we have, okay, the only thing that we can classify as head for sale over here are the non-current assets. Okay, so the head for sale will only be the non-current asset that we classify as head for sale. It's only this one that we classify head for sale. But the current assets, we are going to be selling the inventory like the normal inventory. We are going to be receiving the receivables, and we are going to be maybe any prepaid and those things will be entitled to it. But the only thing that we are selling is the non-current asset. So it will only be these things that will be classified as what? As a non-current asset in the statement of financial position. So that's all about this particular one. That's all about this particular one. So I will just move on to the next one, which is a change to the plan. So the change to the plan is we decide to classify this particular thing as head for sale. But as time goes by, we realize that no, we are no longer going to sell the asset because we need the asset. If that happens, what should be the case? The standard says that if the plan has changed, the asset should be reclassified immediately. However, there are exceptions where after 1 year, the company can still classify the asset as held for sale. The standard says that after 1 year, if the sale is not finalized, then the asset should be reclassified. But there is also a situation where after a year, the asset is not being sold or the asset is not sold, but the assets will still be classified as held for sale. Let's look at that situation. Let's look at the situation where after 1 year, the entity will still be allowed to what? Classify the asset as held for sale. So there are only two situations. There are only two situations. The first one is what is causing the delay is beyond the control of the company, is beyond the control of the entity. So what is causing the delay is beyond the control of the entity. Example can be like, okay, the time that you classify the asset as held for sale, government has passed a legislation to restrict the selling of that particular asset. So maybe it's a software that you have classified as held for sale. Now the government is saying that the software is causing a lot of things. So nobody should sell that particular software within this particular period. That is not your fault. It is something that is beyond your control. You don't have control over it. So if the delay is beyond the control of the entity can still classify the asset as held for sale. Okay. The next one is that management is still committed to the plan to sell the assets. Management is still committed to the plan to sell. Okay, so it's not like you just have to reduce your profit. That is why you classify the asset as held for sale. There's everything showing that you people, you are willing and you are still eager to sell the asset. If that is the case, the asset can still be classified as held for sale. But in absence of these two situations, the asset should be reclassified immediately. The asset should be reclassified immediately. How do we do it? How do we do that? Okay, you assume that the reclassification was not done in the first place. The reclassification was not done in the first place, and the asset should be either be carried or should be reclassified at the carrying value or the recoverable amounts. Okay, since we assume that the asset is carried under cost model, it should be restated at the carrying value or the recoverable amount, depending on which of them is lower. Depending on which of them is lower. Depending on which of them is lower. Okay, so assuming that the asset has a value of 20,000 with a remaining useful life of 10 years. Okay, at the beginning of the year, you decide to sell this particular asset, and the net realizable value was 18,000. So you have classified the asset as this. After 2 years, you have now realized that no, you can no longer sell the asset. So you have to reclassify the asset as non-current assets. What the standard is saying that you have to assume that the reclassification was not done in the first place, and you have to determine the carrying value of the asset at the date that you have changed the plan to sell the asset. So what you do is that you have used the asset for 2 years and you don't want to sell again. So what will happen is that you have to determine the carrying value after the 2 years, and that will be the 20,000 minus 20,000 over 10 times 2. The carrying value will be 20,000 minus 4,000. That will give us 16,000. So if the classification was not done, the asset should have been carried at 16,000. The question now is, they will give you a recoverable amount. So they can give you a recoverable amount of 15,000. It means that as at these days, the asset has impaired. The carrying value is higher than the recoverable amount. So you restate the asset at at the recoverable amount. Let's pick a question and we know what we are talking about. Let's pick a question. We know what we are talking about. All right. Let's take question 6. Auntie Dennis, question 6. Auntie Dennis, question 6. Are you there?
Sorry. IU PLC decided to dispose of one of its major production plants, which had become surplus to requirements at 31st January 2021. All criteria were met for the plants to be classified as held for sale. On 30th July 2022, there was material evidence that the original sale plan will change, and hence it was considered not appropriate to retain the plant as held for sale. Plant is carried under the cost model.
Very
Details
necessary.
of the plans are as below.
Okay.
So required. In line with IFRS 5, non-current asset held for sale and discontinued operation. Recommend how the above will be accounted for within the financial statement of IU. Search rule.
Okay, that's all.
Okay.
Thank you. So when was the decision made to classify the asset as held for sale? When was the decision made? Oh, senior.
So it's 31st January 2021.
I get. Okay. Okay, 31st January 2021. When was the asset acquired? When was the asset acquired? Details
First
of the,
like 2019.
okay. So at the date of the decision, which is 31 December 2021, we have to determine the what? The carrying value of the assets and also the net realizable value. Okay, the net realizable value will always be easy for you to determine. But what about the carrying value? You have to use what you know, how to determine depreciation and those things. So let's determine the carrying value. From 1st August 2019 to 31 December 2021, how many months or how many years is that? Let's determine that. It's very important. If you can calculate it, you can count your fingers. Nobody's going to tell you anything in the exam hall. So if you can't do it, you can write it on the paper. Okay. You have to know that 1st August, if the reporting date is 1st August, then it means that if the starting date is 1st August, then it means that the reporting date will be what? 31 July, isn't it?
Yes.
Okay.
Yeah, sure.
So August 2019 to July 2020 is 1 year, isn't it?
Yeah.
Yes.
Okay. So from August to 31st December, 31 January 2021, how many months is that?
6.
6 months.
That will be 6 months. So it means that we have used the asset for 1 year and 6 months, or 1.5 years, isn't it? Okay.
Yes.
Before the classification. So let's determine the what? The carrying value. All right. So let's determine the carrying value. So the carrying value will be the cost minus the accumulated what? Depreciation. Okay. All right. So the carrying value will be, what is the cost of the asset? It's 20 million. Okay. 20 million. So 20 million minus into bracket 0.1 times 20 million times 1.5. Am I correct? Am I correct with the calculation of the accumulated depreciation?
Yes, please.
Okay. That will give us 20 minus 3. Carrying value will be 17 million. Okay, so we have to determine the net realizable value now. Okay, what is the net realizable value from the question? It will be 14 minus what? So you look at the dates. The net realizable value will be done on this date. Okay. So it will be 14 minus what? 0.4. That's it. So 14 minus 0.4. So the net realizable value of the assets will now be 13.6. Am I correct?
Yeah.
Okay. The recoverable amount of the asset is 13.6 and the carrying value is what? 17 million. Is there any impairment? Is there any impairment on the assets? The carrying value is higher than the what? The recoverable amount, which is the net realizable value. So the impairment will be 17 minus what? 13.6. What are we getting?
Three point four.
3.4.
Okay, I'm getting 3.4 million. Okay, so the asset will now be classified at the new carrying value of the asset will now be the 13.6. The asset will be classified at 13.6 million. All right. They are saying that the original plan has changed. On what date? On what date are they changing the plan? On what date are they changing the plan? It is 31 July 2022.
2021.
No, it's 2022. Okay, is this one?
Okay.
All right, 2022. So at this date, it means that the reclassification should not be done. We assume that the reclassification was not done at all. Then we determine the carrying value of the asset as at this date. We determine the carrying value of the asset as at this date. All right. From 1st August to 31 July 2022. How many months is that? How many months is that? 2020 is 1 year. 2021 is additional 1. 2022 is what? 3 years. Would that be 3 years? Would that be 3 years? The asset was
Yes.
bought on 1st August 2019.
Yes.
So August
Yes,
to
3
July.
years.
Okay, that will be 3 years.
Yeah.
If that is 3 years, then let's determine the carrying value at 31 July 2022. Okay, so the carrying value will be determined as a 20 minus what? 0.1 times 20 times 3. We have used the asset for 3 years already. Now the carrying value is equal to 20 minus what? Would that be 17? Would that be 6? Will it be 14 million? The carrying value, will it be 14 million?
Yes.
Yes,
14.
14.
Okay. Okay. That will be 14 million. Okay. If the classification was not done, our carrying value should have been what? 14 million. But what is the carrying value in the books of the company after the classification? What is the carrying value of that in the books of the company?
13.6.
Okay. So the carrying value should have been 14 million. So what do we do? What do we do to make it 14 million? We have 13.6 in the books. What do we do to make it 14 million?
We reevaluate.
We just add 0.4. We add 0.4 to it to now make it 14 million. But the impairment was 3.4. We should have reversed the impairment, which is 3.4. But the question is, you see the time that you classify the asset, you were not charging depreciation for what? For 1.5 years. So since you are assuming that the asset was not classified in the first place, it means that those depreciation should have also been charged. So within that 1.5 years that we didn't charge depreciation, the depreciation was 3 million. So if you take 3 million from the impairment of 3.4, the remaining balance will be the 0.4. And that is what we are what? That is what we are reversing. Okay. But before you use the carrying value on this, you compare with the recoverable amount. Okay, you can see the recoverable amount is higher. So you pick the carrying value. We only do this to know if the asset has impaired at the date of the what? The reclassification or not. So you pick the lower of the recoverable amount or the carrying value. So the carrying value is lower than this. It means that the asset has not impaired at the date of the reclassification. So if you want to reclassify, you just assume that the reclassification was not done at all. If the reclassification was not done at all, what should have been the what? The carrying value of the assets. Then you compare the carrying value of the asset with the carrying value that you have in the books of the company after the what? After the classification. Then any adjustments will be made as a difference between the two. So if you look at this one, if you look at this figure we have over here, we're having 13.6 in the books and it should have been 14 million. So we add what? 0.4 to make it what? 14 million. So what we do is that if we come to what is the question saying? What are they asking us to do? So they are asking us to show the entries for what? For 31 July. So 31 July, what you do is if you go to profit or loss, if you go to profit or loss, you only do reversal of impairments. Reversal of impairments. The reversal should be only 0.4 because we haven't charged depreciation over the 1.5 years that we classified the asset ahead for sale. So that 1.5 years is 3 million depreciation. So the 3 million has canceled the previous impairment of what? 3.4, and it is now left with 0.4 for us to what? To restate. So we have the statement of financial position, and this will now be the building will now be classified at 14 million, which is the carrying value, That is very simple about the reversal. Let's look at what we call discontinued operations. That is the last one. Then we move on. All right. You see, a discontinued operation can either be an asset that is being sold or that is being held for sale. Okay. You can have a branch somewhere. So if you decide to classify or if you decide to make a decision or if you decide to sell the subsidiary, it means that you are going to stop operations at that particular branch. So if you stop the operations there, we say that you have discontinued the operation there. That's what we are saying. So if you have a subsidiary somewhere that you have now decided to sell the subsidiary, it means that all operations going on the premises of that particular subsidiary will be stopped. So if you stop it, we say that you have discontinued the operation. You have discontinued the operations here. There is no operation going on the premises of that particular subsidiary, or there is no operations going on in the name of that particular subsidiary. So you have discontinued the operations there. All right. So the discontinued operation can be a subsidiary that is being bought solely for resale can be classified as a discontinued operation. Or you have a business unit that is in a different geographical area. If you decide to sell it, you can also classify it as what? As a discontinued operation. Or the asset or the business unit is a part of what? A single business unit that you want to dispose of. So maybe you have a subsidiary which is having maybe the production department, the packaging department, and all those departments. If you decide to close down all the subsidiary, close down the subsidiary as a whole, it means that the production department will be closed down, the packaging department will be closed down, the financing department will be closed down, and you are going to discontinue operations in all of what? These departments. That is what they are saying. If there's a discontinued operation, what do we do? Or how do we do? In the statement of profit or loss, what you do is that you show separately the profit or loss arising from what? The discontinued operation. It can be a figure where you are going to do what? Workings on how you get that particular figure. So it will be a post after tax profits from or after tax loss from the discontinued operation. You show it as a single item, or you prepare a comparative what? Profit or loss statement where you show the operations of what? The continued operation, and also the operations of what? The discontinued what? Subsidiary. Let's pick a question there. Then we know that we are done with that particular one. All right. Okay. That might be the last question. Okay. That will be the question. That will be question 8. So let's take the question 8 first. Then we move on. Let's take the question 8. Then we move on. Question 8. Auntie Bernice, are you there? Auntie Bernice is not here. Auntie Mamiezi, can you help us? Auntie Mamiezi, can you help us with the reading? Or if someone can help us so that we finish it fast. This is the last one. Let's finish this one and move on.
Question 8.
Okay.
Saint Valentine produces cards and sell roses. However, halfway through the year ended 31st March 2006, management took a decision to withdraw from this rose business. The rose business is to be closed and assets sold off. The sales was deemed highly to occur in the following year as at 31st March 2006. This decision is expected to result in redundancy costs to the entity of 5 million Ghana cedis. The decision was duly communicated to the staff involved, and relevant entries have therefore been represented in the accounts of the year ended 31st March 2006.
Okay. Additional information.
1/3 of the trading results of St. Valentine relates to the roses business. Financial cost, tax expense, and any tax payable relates to the card business required. Prepare the income statement of the year ended 31st March 2006 of St. Valentine in accordance with relevant international financial reporting standards.
All right.
Thank you.
Thank you very much, Sina. All right. So the question now is, when was the decision made? It was halfway through, isn't it? Halfway through the year ended 31st March, management took a decision to withdraw from the rosy business. The rose business is to be closed and the assets sold off. So it means that halfway through the year for this particular year, after 6 months of operations, they have now decided to close down what? The business, and they will sell the assets. Okay, so that particular division has operated for only 6 months. Are we okay with that?
Yes.
They have operated for only 6 months. Okay, but this revenue over here is for full year, isn't it? The revenue is for full year. So what do? We find 6 months, then we find 1/3 of that 6 months, because they say the 1/3 of what? The Valentine's what? Trading results relate to what? Roses what? Business. But this is a full year, but they have only operated for 6 months. So we find 6 months of this, and we find 1/3 of the answer. So let's move on. 6 months of 650 is what? Is how much? So we are going to show the profit or loss for the 2 operations. There will be discontinued operation. So we look at statement of profit or loss. Then this will be for continued operation. This will be for continued operation. So we show it for the continued operation. Okay, we show it for the continued operation. So their revenue. Okay, so 6 months of half of 650 is what? Okay, 325, isn't it?
Yes.
Okay, that 325, we are going to find 1/3 of it. If we find 1/3 of it, what are we getting?
Zero 108.
Okay, so 108. So it means that the revenue relating to, so let's be showing the discontinued also as well. So the discontinued operation, the discontinued operation, they are going to be having a revenue of 108. Okay, let's come to their cost of sales. The cost of sales will still follow the same principle, which we are going to be having the half of that, then we multiply the half by 1/3. Okay, what are we going to be having there? So we are going to be having 320, half of 320 multiplied by 1/3. So 320 multiplied, okay, so this will be 325 multiplied by 1/3. Okay, cost of sales will be 320 divided by 2 times 1/3. What are we getting? I'm getting 53.3. Okay, so that will be 53. Let me subtract 53 over here and see what I'm going to be getting. Okay, so they are going to be having their gross profits. So let's find for the continued operation too. It will be 650 minus 108. That will give us 542 against 320 minus 53. That will give us 267. Okay, what will be the profit for the two sides? The gross profit will be what? Gross profits will be what for them? So I'm having 275 for this one, and 108 minus 53, I'm having 55. Okay, let's move on to the next trading activity. Okay, distribution cost and administration cost. Okay, so let's come to distribution and admin expense. So we have the distribution, then we have the admin expense. So let's take them let's take the cost one by one. 60 and 120. So we have 60, 120. So we are going to be having 60 over 2 minus 1/3. 120 over 2 times 1/3. Okay, what are we getting? Okay, this will be 10, and this will be what? Would that be 20? So this will be 20. Okay, they say
Yeah.
something also over there. There's something in the heading there. They are saying that this decision is expected to result in a redundancy cost to the entity of what? 5 million. What is bringing the redundancy cost? What is bringing the redundancy cost? It is a
Because of the discontinued
okay. So
operation.
So the discontinued operation will be the one to bear the redundancy cost. Okay, it will be net against their what? their operations. And that will be 35 against this, that will be 20. They'll be having a net profit of 20. Okay. So this will be 10 over here. This will be 20 over here. So we are going to be having 50. We are going to be having 100. Then we come to finance cost. So the finance cost is how much? It's 20, and tax is what? 38. So the finance cost is 20. So what are we getting? Profit before tax is how much? You're getting 105. Okay. So tax will give you 38. So you are going to be having minus 38. That will give you 67. So this will be named profit from continual operation. Then you bring the profit from this continual operation. Profit from this continual operation. So profit from continued operation. So this will be 20. The total will now be 87 for the year. That will be the total profit for the year. That will be the total. So this is just workings. This is just like workings. So this is just like workings. You show the workings to get this figure and bring it to what? To the statement of profits or loss. Okay, seniors. So this is all about the non-current asset held for sale and discontinued operation. All things being equal. Next week, we are going to be looking at maybe 33 earnings per share or any of them. Whatever be the case, I will let you know. Whatever be the case, I will let you know. But if you have any problem, whether you are undertaking lectures with us, you are attending classes with us, if you have any problem, if it is financial management, financial reporting, corporate reporting, and management accounting, you can actually contact me. Maybe if you have any problem, you can call me. I will sort you out. Okay. So this is my number, and you can actually call me. All right. So seniors, if there are no issues, the day is too young. We shall meet in the evening. Thank you all for coming. I'm very grateful. All right.
Thank you. Thank you. Thank you.